Well, theoretically, they should be all after taxes because our cash flow, remember in capital budgeting, we estimate the incremental after-tax cash flow. So the discount rate should be after-tax discount rate as well, right? The general principle is after-tax cash flow, after-tax discount rate, before-tax cash flow, before-tax discount rate. But general, right? That's not always true. So in this course, we will look at one exception later in chapter 18, right? So in APV, we do not use that principle. But in most of the time, in general, after-tax cash flow, after-tax discount rate, before-tax cash flow, before-tax discount rate. So in capital budgeting that you learn in B10, we estimate the after-tax incremental cash flow. So the discount rate, the WACC, should be the after-tax cost of capital, right? But why only cost of debt is after-tax 1 minus RT? Well, the reason is the cost of equity and the cost of preferred stock, they are both before tax and after tax. That means before tax cost of equity is RS, after tax cost of equity is RS, because dividend is not tax deductible. It will not affect the amount. Preferred dividends, again, is not tax deductible. So if you look at this income statement, now the big box is our total revenue, and the first part we deduct is cost of goods sold, we pay to the supplier, we pay to the employees and everything, right? So now we have your EBIT, earning before interest and tax. Next, we deduct interest. So after you deduct interest, you are earning before tax. Now your tax payment is calculated at this point. That is, if you have interest payment, it reduces your taxable income. It reduces your tax liability. All right? Just like you make a donation. So let's say you make a donation, you pay $100 to, let's say, one of the charity, all right? So the total cost to you is $100. But don't forget, you can deduct tax. You can deduct that amount when you file your tax return. So when you file your tax return, it reduces your taxable income by $100. So let's assume tax rate is 20%. So that means it reduces your tax liability by 20. Or you can think of it as government give you a tax refund of $20. So the actual cost to you, the donation, is only $80. You pay $100, you donate $100, you get $20 in refund from the government, from the CRA. So the actual cost, the after-tax cost is only $80. The same thing here. When a company, they make $100 interest payment, they reduce their taxable income by 100, so they reduce their tax liability by that amount, 100 times whatever the tax rate. So if tax rate is 20%, then they get a tax refund of 20. All right? So if you look at this, the interest you pay will affect your payment because interest are paid before tax. All right? But preferred dividends and common dividends, they are paid after tax. How much you pay will not affect your tax liability. All right? So therefore, the cost of equity is after corporate tax, and the cost of preferred share is also after corporate tax. But for interest, this amount, the cost of debt, RB is the before tax cost of debt. But 1 minus TC, so this is stand for the tax rate on corporate tax rate. So C stands for corporate tax rate, right? So this is the after-tax cost of debt. Okay? So now if you look at the sources and the cost of capital, so this one summarizes everything. On the left-hand side, we have different financing. So those are the people who finance our operation. And the right-hand side are the income or the revenue we distributed to them. They are their return. So if you look at the first portion, which is the largest, supposedly should be the largest, right? So this is the cost of goods sold. So they are the return to the supplier, they are the return to the employees, right? They actually support financing. right? Because they don't pay at the end of the month, right? They work on, your employees, they work for you on January the 1st or 2nd, but they only get paid on the 31st of January, all right? So they actually provide financing of the company, okay? So this is the return to them. Now, the second portion is interest. We deduct interest. They are the return to the bondholder or debt holder. So if you discount this interest by the cost of debt, it should give you the market value of the debt. Right? The value of something is the present value of the cash flow. Right? So if I give you one item and you cannot generate any cash flow from it, you cannot sell it, you cannot use it for any purpose, the value of this thing to you is zero because you do not get anything out of it. Alright? Okay. Even I give you this paper, if you can sell it for $1 million, the value of this is $1 million. Because this is the cash flow generated from this piece of paper. Okay? Now the next will be tax. Now tax actually is a return to the government. Of course, if you look at the balance sheet in accounting, there's no such thing as government. But from an economic balance sheet or market value balance sheet, this is a financing provided by the government. So what kind of asset the government provides? Well, infrastructure. Say for example, highway. So when you do business, you need highway to transport your product to your consumer, to your customers, right? Who build the highway? Who maintain the highway? The government. So they need revenue. So therefore, the tax is the return to the government, right? We need fire service, we need police service, we also need the court system, right, to enforce law and regulation. That's how you can run your business in the society. So those are the assets provided by the government, and this is the return to them. Now the other two is the return to the preferred stock and the common stock. So if you discount this preferred dividend by the cost of preferred stock, you should get the market value of the preferred stock. Now, this is the earnings or dividends available to the common stockholder. If you discount it using the cost of equity, you should get the market value of the common stock equity. Okay, right? So our job, of course, is to estimate what's the cost of capital, weighted average cost of capital. But why weighted average cost of capital? Now the formula is very simple, right? So this is the cost of equity, the required return of shareholder. This is the cost of preferred share, the required return of a preferred shareholder. This is the cost of debt, the required return of the bondholder. And this is 1 minus the corporate tax rate. Now these are the weights. So S is the market value of the stock, P is the market value of the preferred stock, and B is the market value of the debt. All right? So why WACC? Now let me just show you a very simple example to explain why we use this. Now as I said earlier, in B10, we use the WACC approach without telling you. All right? In B10 we said, okay, we estimate the after-tax incremental cash flow, but we do not include interest payments. Right? Remember in B10, when you estimate a project cash flow, we never include any interest payment. We never include any dividends, right, in the calculation, in the cash flow, because we are using the WACC approach. If you include the dividend, if you include interest payment, you get the wrong answer. You actually double count them. All right? So the WACC approach is we do not include the interest payment, we do not include dividend, everything. All right? So now there are other approaches. So in chapter 18, we look at two other approaches, flow to equity and the adjusted present value methods. Okay? So we will look at that in these two in chapter 18. But today, I will introduce what a WACC is, what a flow to equity is, using this simple example. Now, APT is a little bit harder to illustrate using this simple example, so I will leave it until chapter 18. All right? Now, just look at this investment. this investment require $100 today and give you 111 in 1 year. So that's 11% return, right? So let's assume you have $80 in the bank account, that's all you have. So if you withdraw it, you lose the interest, right? So this is the opportunity cost of your equity. Actually, required return of the equity is the opportunity cost of equity. So that means if I do not invest in here, I can earn this return somewhere else. So I must require this minimum return. All right, just like, okay, you go to Bank A. Bank A, they offer a 1 year GIC, let's say 5%. So now you go to Bank B, and now they only offer you a GIC 1 year, let's say 4%. Now you would not invest in this because your opportunity cost of your money is 5%. You can earn 5%, both have the same risk. They are both under the Canadian Deposit Insurance, right? So that means there's no risk. So they have the same risk, they should give you the same return. So this one give me 5%, this one only 4%. So when I go to Bank B, my opportunity cost of capital is 5%. So I would not buy a GIC from Bank B. All right? So the same thing here. Okay? So if I do not invest in this project, I keep the money in the bank account, I get 10% return. So let's assume this project has the same risk as deposit money at the bank. So I also require 10% return, right? So this is my cost of equity. Okay, all right? So if I do not do anything, $80 will become 88 in 1 year. So if I do not accept any project, so this is what I have in 1 year, right? So now we compare the investment. Now this investment requires $100, so I need $100. So I need to borrow 20. So let's assume the bank charge you 15% interest. Okay? So right now you invest in this project. So today you have zero cash flow because you use $80 right from a bank account and use $20 from a bank, and then you invest in this project. So now you have to pay $100 investment. Now after 1 year, you get 111. But don't forget, you have to pay off the debt, right? And then you have to pay the interest as well, 15% of $20. So how much you would have if you invest in the project? 88. So that means today you have 80 and you borrow 20 from the bank, and after you pay off this $20, eventually you get the same amount, 88. So that means this project should have the NPV of 0. Agree? Right? Because this project does not create any value for you. So the NPV of this project should be 0. So let's go to B10. Okay, try and trouble. Go back to a year or something ago. So if you calculate NPV of this project in B10, we said, okay, let's do the calculation. The NPV of this project is investment is $100. Right? We ignore the debt financing. Right? We only calculate incremental after-tax cash flow, but exclude any debt financing. Right? And then we have an investment that gives you 111 in 1 year. So we have to discount it back to time 0, and we know this must be 0. But what discount rate give you 0? Well, 11.11, 11%. So how do you get the 11%? Actually, it's a weighted average cost of capital, because 80% of your investment, you have an opportunity cost or cost of equity of 10%. 20% of your investment, that's $20, you have a cost of 15. The bank charge you 15% interest. So you need to get back at least 15% on this $20 and 10% on the $80. Right? So that means this is your required return of 11%. Okay? So this explains why in B10 we do not minus the $3 here. We do not minus the $20 here, the repayment of debt. So even you ignore the debt. Some people say, okay, we pay interest, but we do not. If you minus $3 here, this becomes negative because you double count the interest. You deduct in the numerator interest, But in your denominator, the discount rate 11% is already include the interest cost of 15% on the $20. So you double count if you adjust the cash flow as well. Okay? All right? So if you use the WACC approach, that is, you use WACC as your discount rate, do not include any debt financing. Even the $20, the borrowed $20 will not be here. The repayment of $20 will not be here. The interest will not be here. Now, dividend, again, you don't need to pay dividend because this is already here. The cost of equity, 10%. That means if you discount something, this should account for the cost of equity and the cost of debt in the discount rate. We already consider that in the discounting process. So therefore, no adjustment in the cash flow, in the numerator. All right? Now, I can easily illustrate the second approach, flow to equity. Now, as the name implies, flow to equity is, let's calculate the cash flow to equity holder. All right? So what in this example, if you calculate flow to equity method, at time 0, what is the cash flow to the shareholder? The cash flow is they make $100 investment, but they get $20 from the bank, from the loan. So the cash flow to the shareholder is only 80 at time 0, right? Okay? And at the end of year 1, the project give 111, but the cash flow to shareholder is not 111 because the company, they have to pay off the debt, they have to pay interest. After they pay off the debt, after they pay interest, then the money will be available to the shareholder. So they pay 20 and they pay interest. So this is the cash flow to the shareholder. So now you can relook at it. What discount rate will give you NPV equal to 0? Easily, 10%. Which is this one here. The cost of equity. Because the cash flow, they are the cash flow to shareholder. I told you the discount rate to be used depends on who received the cash flow. In this project, at time 0, they are the equity holders cash flow. At time 1, they are the equity holder cash flow. So we should discount it using the cost of equity, the required return of shareholders. All right? So if you compare the two methods, WACC and flow to equity method, both try to do the same thing. Calculate the NPV of project when the company use debt. The WACC approach is to adjust the discount rate to incorporate the benefit or the effect of debt financing. The flow to equity method does not adjust the discount rate. So you can see this 10% does not have the 15, right? We do not have that 15% cost of debt in it, all right? Instead, we adjust the numerator, right? Flow to equity is to adjust the numerator. Now, APV approach is a slightly different approach. It is hard to use this example, but I will talk about that in chapter 18. APV approaches, we do not adjust the numerator, we do not adjust the denominator. Instead, we add an extra term. We add an adjustment. So that's what we call adjust the present value. We add an adjustment. That calculation is to determine the effect of using debt instead. All right? So the three method, one is to adjust the cash flow. The second, which is the flow to equity. The second method, WACC, is to adjust the discount rate. The third method, APV, is to adjust a separate term, right, to incorporate the effect of using debt. So all three methods try to serve the same purpose, but different ways. Now, under certain setting, theoretically, the three methods should give you the same NPV. but in reality, almost never. All right, almost never. But they most likely they will give you the same conclusion, whether it's a positive, they should accept it or reject it. But the NPV value you get should be different most of the time. Right? So we will look at that and explain why in chapter 18. Okay? Now, which is the hardest topic, capital structure, and this three method are the hardest topic in this course. Right? So that's why you will see it again and again and again in lectures. Okay? So after we said, okay, if we have the company, then we should use the WACC. So how do we estimate the WACC? Well, we have to estimate each component. So if you have preferred stock, then we need to estimate the required return of the preferred stock. So in a textbook, they assume preferred stock pay a constant preferred dividend. So that means each period or each year, they pay DP. So this is the preferred dividends paid to the preferred shareholder, right? And if we know their required return and we discount it, since this lasts forever, then you should get the price of the preferred stock, all right? So what we can do is, well, let's do some little trick. Go to the market and observe the preferred stock price. So assume this is correct, all right? Assume the market is efficient. So this is our value. This is, you can observe in the market price. And you also know, according to the contract, what is the preferred dividend per period. And then we estimate the preferred required rate of return. All right? So this is a very simple simplification. And because in real life, a lot of preferred share, they don't pay constant preferred dividends. All right? Many of the preferred share, they reset their preferred dividend rate every several years. Very common, 5 years. That is, maybe when I issue the preferred share, I promise to give you, let's say, 5% preferred dividend every year. But after 5 years, they will reset the preferred dividends according to our formula. All right, so that formula may be the government bond yield plus 2%. So this will be a new preferred dividend for the next 5 years. So very likely they reset the preferred dividends every 5 years. All right, but in this course, if we have preferred share, we always assume they pay a constant preferred dividend forever. All right. Now the next is, well, if you have a perpetual debt, that means this debt never mature, lasts forever, then what will be the cost of debt of this one? All right. Now in assignment, there's several debt. The company has several debts. Then you have to calculate the weighted average of cost of debt. So if you look at the end of chapter problem, it will help. All right. So before you do the assignment, try the end of chapter problem first. It will help you to do assignment 1, question number 1. All right. Now, if the company has a perpetual debt, well, the same thing. They pay interest forever, a fixed interest forever. So if you observe the price and work backward and find out what's the yield or the required return of the bondholder. So basically, this is the yield to maturity of this perpetual debt. So the cost of debt is the yield to maturity, the required return of the bondholder. All right? Now, the next type of bond the company may have is a zero coupon bond. So a zero coupon bond means, let's say this is year 1, year 2, year 3, means they have nothing today. Right? You pay this amount to buy the bond and you receive the principal. So usually we assume $1,000. This is a typical assumption in B10, C10. All right? So you get $1,000, the face value or the part value back at the end of year 4. So what's the yield? Well, go work backward and solve for the discount rate. Right? The present value of this face value is equal to the price. So what is the yield? Okay. Now this is for coupon bond. That is if the company pay coupon. And at maturity, they pay you back the face value. All right? Now, if you have a financial calculator, it's easy. If you have Excel, it's easy to find this yield. Now, in Excel, there's a function called rate, R-A-T-E. Right? So you can use that function to find the internal rate of return or the yield to maturity of this bond. Now, in examination, if you do not have a financial calculator, I will accept the approximation formula you learned in B10. Okay? But for assignment, I only accept financial calculator or Excel. So if you do not have a financial calculator, use Excel or use any of the online financial calculator, okay, to find the yield to maturity. But one thing you have to be very careful is, in this course, we always assume bond pays semi-annual coupon, all right, unless the question said otherwise, all right? So if you have semi-annual coupon, that is your interest payment every 6 months. So I is the interest payment every 6 months. And you discount it, so RB will be a 6 month discount rate. All right? So after you get your RB, you have to multiply by 2 to get the annual rate. All right? Because when you calculate the cost of capital, we always use the annual rate. Okay, so you have to multiply by 2 to get the annual rate. You don't need to use the effective annual interest rate. Just multiply by 2 is fine, because this is kind of a practice in the market. All right? Now, the next one will be the cost of capital, which is the hardest to estimate. Okay? Now, this diagram illustrates the idea. Actually, you will use this concept very often. Actually, you see this in B10 as well. All right? Now, this one said when a company have excess cash, we call it free cash flow. That is, after they make the necessary investment and they still have some money left. So we call this a free cash flow. You can do it whatever you want. You don't need that money in your operation. All right? So you can either reinvest, make some investment, or you pay this money back to the shareholder. Okay? So if you reinvest, assume you earn ROE. So that's what you have at the end of one period. You earn return on equity, ROE. Right? Now, if you pay the $1 as a dividend to the shareholder, and the shareholder, of course, they do not just keep the money, they do not keep the $1 in their pocket, they will do some investment. So assume that they will earn the cost of equity. Now, why do we make that assumption? Right? Because we said this is the opportunity cost of capital. That is, if they do not invest in our company, they can earn this return from a similar level of risk investment. All right? So therefore, if we give this $1 back to them, they probably would do the same thing, invest in a similar risk investment. All right? So they should earn this return. Now, the two at equilibrium should be the same. All right? That is, as a manager, if your ROE is greater than your cost of equity, you should reinvest. That is, I can earn 10% for you, and you can only earn 5%. Then you want me to do the investment, right? You want me to keep the money and invest on behalf of you. Because I can earn 10%, my ROE is 10%, your cost of equity is only 5%. So that means you invest yourself, you only get 5%. All right? Okay? Now, if my ROE is, let's say, only 2%, and if I give you back the money, you can earn 5% yourself. So you want me to give the money back to you. All right? So this is related to dividend policy and also related to growth. Remember in B10, when we look at the constant growth model, the growth rate is what? The retention ratio times your ROE. That's the growth rate, ROE times B, the retention ratio. Okay? So in that discussion, we also have the same conclusion. A company could grow, they can grow, but not a healthy growth. If the ROE is less than the cost of equity, the company is growing, but the stock price is dropping because it's not a healthy growth. Right? You're getting bigger and bigger, but your return is less than what the shareholder want, then your share price will be lower and lower and lower. All right? But if your ROE is greater than the cost of equity, now that is a healthy growth. You can generate a return higher than the shareholder want, then you keeping more money, reinvesting more, actually create value for the shareholder. All right? Okay, so that's just exactly the same conclusion that we have in B10. All right? So this argument said, yeah, right. So at equilibrium, the two should be the same at equilibrium. That is, a manager, you should keep investing the money until the point your ROE is equal to your cost of equity. At that point, you should stop reinvesting. Right? Because when you choose your project, first thing you do is you pick the one with the highest return. Right? Next project will be lower return and so on. You rank all the projects according to the return, and you choose the one that gives you a high return. Okay? And then you should stop at the point when your ROE equal to RS, your cost of equity. Right? Now, to estimate the cost of equity, you can either use the constant growth model. So we know the constant growth model is the price of the equity is equal to the expected dividend in the future period, 1, divided by the cost of equity minus growth rate. So if you rearrange the equation, we have the cost of equity is equal to the dividend yield plus the growth rate. So this model actually said, well, the shareholder return comes from two sources. One is the dividend yield, the dividend return. The second one is capital gain, the appreciation in stock price. All right? So to use this model is kind of hard. One thing is you need to determine the growth rate. And you also have to assume it's a constant growth rate. Not many companies will have a constant growth in dividend, in price, in asset per year. All right? So that means if you apply this model, you can only use it for really a maturity company. That means they have almost dying or about the same forever, then you can use this model. But for most companies, it's just hard to use this model. All right? So that's why in this course, we use the capital asset pricing model, CAPM. All right? So the CAPM. Now the CAPM model said, the required return of any security is equal to the risk-free rate plus the beta of that security times market risk premium. That's what you learn in B10, right? Theoretically, this should hold for all risky assets in this world, right? Now, if you have your beta of equity, that's a share price equity, using this equation, you should get the cost of equity, right? So if you know the equity beta, so sometimes you go to Yahoo Finance and they publish the equity beta of the company. So they use regression, run the regression using historical data, right? But some of the websites, they give you different answer because they use different methodology, they use different time period. Some may use 3 years, some may use 5 years, so that's why the beta they provide are different. Right? Okay. Now, if you know your debt beta, the beta of the debt, now what you can get is your cost of debt. Now, if you know your asset beta, that's a risk, to measure the risk, the market risk of the asset. Now, what you can get is your required return of your asset. Now, sometimes we also call this R0 or R0. Okay, so you will see this term very often, but they mean the same thing. That is the required return for the asset. This is the required return of a firm when there is no debt. So that's why 0 or not means when there's no debt. So when there's no debt, that's the same as just the company asset. All right? Now, this equation said any security return, anyone, you can always earn the risk-free rate, Right? Anyone, if you don't want to take risk, just buy government treasury bill. You can always earn that return for sure. But if you're not happy with such a low return, you want to take a little bit of risk, then you have a risk premium. So this is your risk premium. Now this one is the same for all security. This is a market risk premium, or just called market premium. So in this example, the market premium is 10%, or the market risk premium is 10%. So be careful in the quiz, in the examination, in assignment, read carefully. All right, whether the question gives you the market risk premium directly, or the question gives you the market return. Now, if the question gives you market return, you have to subtract the risk-free rate to get the market risk premium. Now, if the question gives you the market risk premium directly, you don't need to subtract the risk-free rate. Okay? This is a common mistake students have, or had in the past. So don't confuse the two terms, market return and market risk premium. So this is the market risk premium. Market return is 16, market risk premium is 10. Okay? So if you have a company that use all equity, then your WACC will just equal to RS because you give 100% weight to equity. So if you have a similar project with similar risk, then you should use 21% of discounted. Now, if your new project has a different level of risk, then you should not use 21%, because 21% represent a risk level of 1.5. All right? If you have a different risk level, your required return will be different. High risk, high return; low risk, low return. Okay? Now, so if you look at it, this is the security market line in CAPM. I hope you still remember. So with a beta 1.5, according to the security market line, which is this equation, all right? And the required return should be 21. So if you have a project A here that gives you a higher than 21% return, project A is a good project. Now, if you have a project C that gives you a lower return than 21, that means C should be a project you reject. Right? Okay, so the decision rule is based on the risk, always based on the risk. Now, how do we estimate beta? Because we need that beta. This is the most important information to estimate it. So the formula for beta is, well, beta of any security or anything. I stand for anything, right? So that's the covariance of I and M over market variance. Right? If you rewrite it, this is correlation of I and M, sigma I, sigma M, standard deviation, or market variance. Or you can write it this way. So they're both all the same. But no matter what, you can see the beta actually measure the correlation. That is how likely your stock and the market move together. The cyclicity. That is whether your security, your stock, move up and down with the business cycle. Now, if your stock move up and down with the business cycle, then the correlation will be high. Then your stock will have a higher beta. Then you require higher return. Because now you have a lot of market risk. If the market is good, you have a lot of revenue. If the market is bad, you have a lot of negative or loss. Right? So you don't want that. That's risky. So that's why you require higher return. All right? So what kind of company will have a higher correlation, a higher cyclicity? Well, luxury product. In good years, people spend a lot of money in jewelry, sport car, or luxury product. In bad year, people do not spend any penny on those products. They only spend the money on basic needs, grocery, right? Electricity, water, whatever. Okay? So for those necessity, that means they have a stable cash flow. No matter what happened to the market, up and down. So their cash flow are relatively stable. Then they have a small coefficient role. Okay? And also, if they are very stable, that means their standard deviation is small as well. All right, so they have a lower beta, and those companies you require low risk because they don't have a lot of market risk. All right, so think about the stock extremely volatile, and also it moves up and down into the market, then you require very high risk because a high return, I mean. All right, so you can see beta actually is a relative measure because the denominator is the same. No matter it is a stock, it is a bond, it's security 1, security 2, security 3. The denominator is common, right? So this is a ratio. This is a ratio. It measures the market risk, relative market risk. So if you have, let's say, so what is the beta of the market? So you can see this is sigma mm over sigma m squared, which is 1. Because sigma mm is just sigma m squared. All right? So that means the market is the standard or the anchor. All right? And we measure the market risk is relative to this 1. If you have a high, let's say if the beta is 1.2, that means you have 1.2 of the market risk. If the beta is 0.8, you have 0.8 of the market risk. All right? Now, standard deviation, 10%, 20%, it is an absolute measure. All right? So that means you measure risk in percentage, standard deviation. But this one is a relative measure. There's no unit. This is just a ratio. 1.2, 0.5, 0.8, and so on. All right? Okay. Now, most, you can see here, from here, most people argue, yeah, beta relatively stable. Yeah, that's true. That's true. But if the company has a significant change in their product line or technology, then their beta may be different. Because let's say I'm a company, let's say in grocery, so relatively stable, relatively small beta, let's say 0.8. But suddenly, I change my company's strategy. I move into technology. So now my beta will be 1.5, maybe 1.6. Right? If you look at MicroStrategy, for example, it was a software company a few years ago. So even software company, their beta is high because software is still a little bit risky, all right? But now they move all their assets almost in Bitcoin, all right? So now if you look at its volatility, its beta extremely volatile, all right? The stock can increase 400% in just a couple of months and drop like 60% in just 2 days, all right? It depends on the Bitcoin price. So yeah, it's still the same company. They still have the software business, but now most of the assets, they are Bitcoin. So now the beta is different, extremely larger. All right? So the beta may change over time. Now, another thing is, even though your company is the same as the industry, but if your leverage, if your debt is different, then you need to adjust it. Now, this is something I will talk about next week because you need it in your assignment 1, question number 1. That is based on this equation right here. Now, the beta of equity is equal to the beta of asset plus the beta of asset minus beta of debt times debt to equity 1 minus the corporate tax rate. Now, how do I get this equation? Now, this equation actually comes from the famous M&M proposition number 2. Now, you will see this equation in about 2 weeks, all right? So we will talk about this equation. So these two are the same. Now, this is the M&M proposition number 2. That is the equation we will have in 2 weeks' time. Now, we know that this is also one-to-one relation, remember? If you do not believe me, try it. Substitute this beta of S, beta B, beta A in the equation, you will get exactly the same thing. All right? So this means what? The equity shareholder market risk has 2 components. The first component is related to the business risk, which is this one here, which is it depends on the beta of the asset risk. That is the business risk. If you invest in this industry, there's nothing you can do. You have to face the risk. As a shareholder, you have to face that risk. That is, if I invest in startup, venture capital, right, or invest in Bitcoin, then I have to face the risk. There's nothing I can do. All right? But if the company also use debt, that means they borrow money, actually increase the risk, because now you have two risks, not just the business risk, you also have the financial risk as well. So the shareholder now, their total risk will be the sum of the two. That's why you add the two. Your return is also have larger. Now because I have higher risk, I require higher return. So this is the return to compensate for the business risk, and this is the extra return to compensate for the extra financial risk. All right? So what will affect the business risk? As I said earlier, the cyclicity of the revenue. That's how your revenue move up and down with the business cycle. The second thing is the operating leverage. Operating leverage means what? Well, how much fixed asset you use in your production. If you use a lot of production, then you have a higher risk, because if I have a fixed cost of $2 million, that means even I have no sales, I still have to pay $2 million. But if I don't use fixed cost, then if there's no sales, then I don't need to pay the $2 million. I don't need to hire any labor because there's no sale, right? So financial leverage is measured by the amount of fixed cost used in your production. Okay? Now, the next one, the final one, the financial risk, is based on the debt to equity ratio. That is the financial leverage. Now, this is similar to the fixed cost argument, because debt financing is a fixed cost of financing. Because no matter what, even you have money, you don't have money, you still have to pay interest. It is a legal obligation. But dividend, common share, now it is not a legal obligation. Some companies, they don't pay dividends. There's no requirement of the company paying dividends. So if the company does not have money, they don't pay dividends, that's fine. But interest, no matter you are good, you are bad, you have to pay. If you do not pay, the creditor will file bankruptcy against your firm. You liquidate at the end. All right? So this is what we are looking at next week. Now, I believe after next week class, we talk about operating leverage, we look at financial leverage, and we look at the adjustment for the beta. And after next week's lecture, you should be able to finish assignment 1, question 1, and question 2. All right, so please start early. Okay?